Good afternoon, everybody. Thank you for taking the time to join us, and thank you to the Peak Path team for hosting. I'm Mike Begley with Clark Capital. I also have Ryan Gardner, our Senior Client Portfolio Manager, here today, this afternoon, to go over the top questions that we're hearing from advisors and investors right now. So, if the last few years have felt different, it's because they have. We've had concentrated leadership in markets. We've had higher rates than we've seen in over a decade. There is a lot of noise around elections and geopolitics and recession calls, and it creates a constant temptation to react. Today really isn't about predictions, it's more about perspective. And so Ryan's going to walk through the top questions that we're hearing from our investors right now. And we pay attention to mainly three things: what's actually driving returns under the surface, where risks are building that aren't obvious, and why discipline and portfolio construction matter more than the headlines. And with that, I will turn it over to Mr. Ryan Gardner, CFA.
Great. Thank you, Mike, and good afternoon to everyone. I really want to echo what Mike mentioned. So as part of the client portfolio management team, our mission is to partner with elite financial advisors. So that would be with Mike, Melissa, and the team at Peak Path. We really want to provide that industry-leading service and asset management excellence. So these webinars will give us that opportunity, like Mike mentioned, to go through what are those top questions we are getting from across the country. We have the privilege to partner with elite financial advisors and do client review meetings, so we get a good idea of what are some of these questions. There will be opportunity at the end of the formal agenda and presentation to pose any questions for any of you that may have those questions, and then importantly, focus more on the signal. We know there is a lot of noise, like Mike was going through in terms of out there. So what are some of those top questions we get? We do regularly update this content. Some of you might be thinking some of these questions, like I mentioned, there will be that opportunity to pose questions beyond if some of them are not covered on this. So we're going to go through these questions in detail. So starting first with the Federal Reserve and what is the impact of the Fed. So we've heard recently that President Trump has nominated Kevin Warsh as the next Fed chair. So Chair Powell will be stepping down in May. So if the Senate confirmation process goes ahead, Kevin Warsh then would be the new Fed chair in June. So this is a picture of Kevin Walsh actually at the SON conference. So this is an investment conference. So this is what's always pleasing, particularly from my perspective. I always have a bias to someone who has the potential to be a Fed chair that has capital markets experience. So let's look at his background. What is the pedigree that Kevin Walsh has? Most recently, been working with Stan Druckenmiller. Some of you might know he's one of the most successful investors. I have very much a macro mindset when I talk about investments. So that's very much looking at what's happening with the economy, what are central banks doing, what's happening with inflation, how does that form one's view of the investment world. That is very much the view of Stan Druckenmiller and Kevin Walsh being a very important member of that team. Before that, we all know was part of the board of governors at the Federal Reserve, so already has that expertise and insight. And then in his early years, certainly in his 20s and early 30s at Morgan Stanley in the M&A. But what we do know with the checks and balances of the Federal Reserve, it is not one person. Yes, you have the Fed chair, but there are other voting members. So there's 12 of the 17, and you have the rotational basis of the non-voting members with the 12 that are voting. But there generally might be, the Fed chair might want to get consensus amongst the voting members, but we will have 12 of those votes that count. So let's think about, Mike mentioned it up front. We've had higher interest rates. So this was what the Fed embarked on in 2022 when they raised interest rates. This was the most aggressive interest rate increase since the 80s when the Fed increased those interest rates. So that's great. Now, once we post that event, if you hold bonds, fixed income in your portfolio, you do get a higher interest rate. But we've been on the slow decline lower where we are with rates set by the Federal Reserve. Now, the brown line on screen here, this is where the Fed themselves believe interest rates will be. They're not married to this position. This is where they have a view on their own interest rates. So you can see generally is a lower view of interest rates from this point forward compared to where the blue line is. So the debate is when will these interest rates happen and how quickly will they be? But you'll hear language around the Fed talking about being restrictive. So anytime you see that blue line above the brown line, the Federal Reserve are still trying to slow the US economy by keeping interest rates restrictive. Anytime rates would be below that brown line is where they're trying to be accommodative and inject growth in the economy and get interest rates a little lower. So let's look at the dispersion or the some of the discrepancy you might see and the voting members. This is sometimes called the dot plot or just the projections of the different members. The brown dots were the September meeting. It comes out every 3 months. And then December is the blue dots. And you'll see what the median is. But look at that dispersion between where some people may want to be increasing interest rates, whereas some want a meaningful reduction in interest rates overall. But you'll see the balance in the middle and the median overall is where most are seeing the lowering of interest rates. So the March meeting will be the next update where we get more insight into what the Fed themselves think of how they look at interest rates. We have seen pivots before. That's a fancy term that the market uses for the Fed doing a U-turn where they have made changes because this is very much data dependent. You'll hear those terms. What's happening with the US unemployment rate, what's happening with inflation. That is their mandate. They want to keep the unemployment rate as low as possible, or full employment is another way of looking at it. And secondly, to keep inflation towards 2% over the long term. So what does the market believe? The current projections are around about two interest rate cuts for 2026. At Clark Capital, we started the year, so in early January, we were thinking about three interest rate cuts. So you can see the balance of probabilities. The Fed believe they're going to lower interest rates. The market believes we're going to have 2 to 3. So like I mentioned a little earlier, the debate is just when and how many we'll have. But this is a favorable tailwind to have. It's generally good for bond investors. It's really good for stocks as well. But what we have to be patient for is a gradual and slow reduction to interest rates overall. This is showing different interest rate cycles. The blue line is the most favorable or a slow cycle. This is less than 5 interest rate cuts over a 12-month period. And then the brown line is showing a fast cycle, which is still positive on screen over here, but it's not nearly as positive as the blue line. A fast cycle is 5 or more interest rate cuts over a 12-month period. You can think of an environment when the Fed are dramatically reducing interest rates. That's typically indicative of the economy struggling, and hence they have to make more drastic action to lower interest rates in let's just say, a more hastily fashion than being more patient. I know many of us want lower interest rates tomorrow, but we want this Goldilocks environment, the economy not too hot nor too cold. And this is perfect equilibrium somewhere in the middle is what the Fed's trying to achieve. And that is typically, you can see in the blue line, the most favorable. So what is the current cycle? This is the orange line. We went into this before the first rate cut, which was September 2024. We almost borrowed quite a few returns heading into that. And the reason for this, Chair Powell, some of you might listen to his speeches. He does a semi-annual testimony in Congress, one day in the House, the second in the Senate. He does a lot of work at Jackson Hole, the annual economic symposium in Wyoming. Very nerdy central bank conference once a year. But this is where the Fed talk a lot about their forward guidance and where they think interest rates. They're not, cementing their views of where they think rates will be, but they're just giving the market insight into what their best thinking is at that time. So you can see going into that initial rate cut, it was pretty much expected from where it was. But if you look at the typical playbook, it's almost happening in accordance with time with the blue line. So pretty pleasing to see, even though we had a good start for this current cycle in the orange line, it's even post that initial rate cut, we're pretty close to that blue line, even though we had good returns heading into that initial cycle. I want to move to the next question on are we in a bubble? We've got many questions over this. There's been a lot of literature written on this topic. So what we spend a lot of time analyzing, and this is what Mike really focused on. This is one of the most important, charts to focus on in this presentation. Certainly is available for any of you who do want to look in this in more detail post this webinar. But the blue line is showing the price level of the S&P 500, and the brown line is showing the profits of the S&P. And you can see how well intact that relationship is over time. This is since the early 2000s between the price and the profits and that makes a lot of intuitive sense. The more profitable a business is, the more an investor is willing to pay or invest into that stock. Now, there will be mismatches over time. You can see how that's not a perfect relationship, but the broad principle certainly applies. So let's look at what the current Wall Street estimates are. 2025, we're towards the end of Q4 earnings season. So this number here will no longer be an estimate. This should be concluded. But let's look at 2026, and you can see this continuation of pretty much record profits are expected for the S&P 500 and corporate America in general. So despite what we define as a constant wall of worry. Uh, Mike and Melissa know this very well. There's a lot of anxiety. You think of geopolitical risks. We're 4 years into Russia, Ukraine, even through 2026, we've had Venezuela. Even more recently, tensions with Iran. Think Greenland. Think tariffs, that's still a big one. Even with all that, we have AI disruption impacting some of the software names. We still have, pretty well intact profits overall for the S&P 500, but there will be winners and losers. We're not saying all stocks are going to do well. You still need that active manager to deviate from areas that will be struggling. Just think with tariffs, if you've not had the opportunity to move your supply chain out of areas that are being significantly impacted with tariffs, clearly your business model is under pressure. But why we spend time on this is you can see historically when we've had profit recessions, think the global pandemic, that's when the S&P was under pressure. 2022, we had high inflation, we had supply chain issues coming out of the pandemic, that time environment, slight drop to profits. But why we've been, pretty robust in terms of the S&P in recent years is based on these profit levels overall. So looking more on a quarterly basis, we haven't seen these estimates. If we exclude this anomaly coming out of the pandemic, these numbers were really just coming off those low levels overall. We haven't seen these levels of profits since late 2018, if we just compare it to those timeframes there. So, pretty healthy profits. We know a lot of this driven by productivity gains expected from AI. The health of the US economy is driving this. But I want to spend some time looking at the changes we do see. A lot of squiggly lines on screen here, so I'm going to go through it in a little bit of detail. But let's focus on 2026 and 2027. So this is what the market spends time on: forward-looking profit estimates when corporations. So when we had all the tariff scares, Liberation Day, corporate America in general were lowering their estimates on profits, and so was Wall Street. A lot of uncertainty was weighing down on profit estimates. So as soon as that cloud of uncertainty started to lift, I'm not saying things are certain, it's just less uncertainty, and we had that economic resilience coming through. We've seen an increase in those profit estimates. So look at that 2026 and 2027. We've just seen a continued increase in those profit estimates overall. Now, this is the average across Wall Street. To give our view at Clark Capital, we had about 350 instead of 360 that you can see on screen. So if you look at that number of 350, the average PE ratio for the S&P 500 is 22. So if you take that 22, you multiply by 350, you get a price target of 7,700, which is what we have for the S&P for 2026. That would be roughly about a 12.5% price return to the S&P for this year. So just to give you some insight that when you hear about these price targets, they are driven by, in our analysis, pretty robust profit growth off the back of what we're seeing with these earnings. Looking at valuations, this is important for looking at those relative to growth. So yes, PE ratios might be elevated, but if you look at relative to growth, they're far more palatable and reasonable overall. So we thought it'd be important to include the Fed when we look at this. This is a great quote by Art Cashin. I don't know who he was, Glenn Dorsey, who works in our team, industry veteran, over 40 years experience. He actually worked with him at Payne Weber, at that time. And he had this great quote of just talking about how, how influential the Fed is. And we're not in that environment, as I showed. We're actually in an easing cycle where the Fed are expected to reduce and lower interest rates. So shifting to the third question on commodities, I know certainly Mike and Melissa get a lot of questions on this, particularly in a year like 2025. And let's just look at commodities in 2026. This was towards early February. Even despite that huge downward movement that we saw, just focusing on silver, this was the biggest move since about March 1980. What was the catalyst for that? That was the announcement or the nomination rather of Kevin Warsh as the Fed chair led to that catalyst. So, there were concerns about Fed independence, things like that. This led to a lot of confidence. The market believed in that type of nomination. There was obviously a huge price appreciation. There's a lot of factors that go into this, but there were questions we've got, what specifically led to that day while we saw that downturn on some of these metals. A slightly longer view. This is since early 2023. We wanted to include some equities. This is looking at the Magnificent Seven in green, comparing it versus gold, platinum, and silver. So just a slightly longer time frame. And in our analysis and view, equities, you own a sort of a partnership or an equity position in a business. Therefore, you're an equity holder. You have the potential to participate in dividends and the value creation of that business. There's revenue. And based on that, there are more established valuation methodologies of how to determine what is the fair price on that business because you have that tangible cash flow and that profits. And I went through, those earnings of how we can underpin that. Whereas commodities don't have, those profits. They don't have, that actual business behind it. It is based on supply and demand. And we have this market clearing price, which is why some commodities can be more volatile. So we're not saying whether it's right or wrong in a portfolio, but just acknowledging that volatility aspect needs to be considered. I know a lot of investors like to focus on the upside, but we need to bear in mind that downside needs to be considered as well when thinking about specifically looking at commodities in a portfolio. So, linked to commodities has also been on the dollar weakness. That's been a big question we've had. So what is the effect of the dollar? Giving a balanced view of the positives and negatives. There are some positives for having a weak currency. Earnings is sometimes a big beneficiary. 42% of the revenue of the S&P 500 is derived from abroad. So translating euros, British pounds, Japanese yen back into US dollars helps to these very successful multinational corporations that are listed on the NASDAQ or New York Stock Exchange do benefit from a weaker dollar. Certainly the manufacturing export side does well. They become more competitive, and we know international stocks. So what are the negatives? And this is the balance we want to have. You don't want to have massive weakness in a currency like we see in emerging market currencies when you see a 50% plus depreciation in a currency, almost a collapse in that currency. We're not talking about that significant weakness, where it leads to debt issues and that sort of spiraling of problematic issues for the economy, but just slight negatives. International travel, we know a lot of our clients certainly experience that. And then on the imports, and that has the potential to be impacting specifically inflation. If we look at the goods that are imported, might at a weaker currency have that impact. So what has that done for, let's look at the 10 years, the currency. This is looking at the dollar index. It's the value of the dollar versus the major global currencies. As the blue line basically flat over 10 years, it's down only 1%, almost no bearing. You can see over the S&P 500, that was linked to what I was showing earlier about earnings growth. That's very important. If we look at it since 1989, it's down only about 5%. So yes, a little weak over that period, but not massive movements. And you can see, I had to double check this number. That's over 4,000% return to the S&P 500 since 1989. So with a very muted, change in the currency over that time frame. So almost very little bearing of currency impact over that time frame. So looking specifically from a stock perspective, I mentioned how it can benefit certain businesses. If you look at where some of the real positive earnings growth is coming from, if you think about a business like Facebook or Meta, more than 60% of their revenue is derived from outside the United States. So think about these highly successful technology names that are generating revenue growth from outside. They can really benefit from that overall earnings growth. So what areas on the market are interesting to us? Where are some of the opportunities? I certainly know for clients that have a well-diversified portfolio, want to commend those clients that did stick to international. I certainly know Mike and Melissa have been keeping a big focus on this because it's underperformed, for a considerable period of time. So for those clients who did stick to international, were rewarded in 2025, and this is showing the valuations between the U.S. and international stocks. Now, in our opinion, the U.S. should command a premium to international stocks. The earnings growth is there. We think about this superiority of the economy and the growth rates, just the US exceptionalism. But it just had got too stretched if you look at that blue line versus the red, versus what it should be versus historical averages. And we reference it as a coiled spring. At some point, it's going to snap back. If we just think about going back to early 2025, you just never know when it's going to be at that point. What that potential catalyst could be. And 2025 happened to be that catalyst where we saw international really play catch up. And you see that red line really increasing in that valuation. Some investors were calling it that international was cheap for a reason. Now, there is some validity to that, but it certainly had got too cheap. And you can see just how low that red line had got versus US equities, trading at, higher levels of valuations. Within the US, there are opportunities to mid and small cap stocks. So outside the S&P 500, much lower levels of valuation. So the red line is showing large caps. So the S&P at about 22, mid and small between 15 to 16. So almost similar levels of valuation to the international. And what's really exciting for us is we are actually starting to see this earnings growth accelerate within mid and small cap stocks. You can see more recently, if you look at that blue and green line, is really increasing at a faster rate and accelerating more than the large cap growth names, which gives us more reasons. It's not just valuation. We are seeing that earnings growth that's really driving a lot of these opportunities. But just give me the context of the background work, that the team will be doing on these individual stocks within the different investment universe. Switching to the economy, this is certainly one of the top questions we are getting. There's different ways of phrasing it. I think one of the most eloquent ways of thinking about it, this is, the media, financial media spend time on, is the K-shaped recovery. It is nuanced. You have high income households that are doing very well. Low income households certainly are under a lot of strain. They are under pressure, particularly low income households. I think a lot of their expenditures on, think rent, food, gasoline, a significant part of their monthly expenditure on those items, whereas high income households, that's a much smaller part of their expenditure. So we look at a lot of surveys. University of Michigan do great work on consumer sentiment. You can see in the blue line here, people are basically telling us on average they are extremely unhappy. If you look at these levels that we had in November, this got to 51. If I just draw a line of 51, it's basically telling us, other than 2022, people have not been feeling this depressed on the U.S. economy, which is, really showing us, how unhappy people are feeling. Now, there are, reasons that are, fairly obvious. You think about 2022. Think about high inflation. We got to about 9%. The average price of gasoline across the country was over $5 a barrel. Unemployment rate. So there's a lot of factors leading to this. Whereas it has been more perplexing more recently. So we'll delve into a lot of the reasons for this. But if we look at other surveys, this is coming out of Deloitte, looking specifically at financial well-being. So you think about people's confidence in their financials, their comfort levels and savings, their income relative to expenses, and just general personal financials is a lot better of a situation. And what I've included on this data point is looking at inflation, which we know if we go back to 2022, this huge dispersion here when inflation got to towards that 9% threshold. And people even then were feeling pretty bad on their financial well-being. So in summary, uh, on average, people are just feeling grumpy about prices, and they're extrapolating that to feelings on the economy. You'll notice I'm not referencing inflation. Inflation is lower. You can see on screen here with the brown line. It's trending towards that Fed's target. We are below 3%. The latest number we had on CPI, was 2.4%, which is the lowest in a number of years. But this means that prices are still increasing. It's just the rate of change is slowing. So capital markets, we spend time on inflation. I know the average person spends time on prices. So that's why we have the two definitions overall. And I will come back to inflation in more detail. So what we spend time on is not necessarily how people feel. We don't spend time on that. We talk about actions speak louder than words. And what are people doing? They're still spending. So this is the blue line is GDP, so economic growth. The brown line is focusing on actual spending. And you'll hear terms about 70% of the US economy is driven by spending. So this is that blue line, pretty robust. So despite people being unhappy, they're still spending. So we thought we'd spend some analysis on where is that spending happening. So broadly, it's across the different, if we split it across, let's just say low, mid, and high income households, but the bulk of the increase is certainly happening on higher income households. You can see on the right chart there when we look at that. And this is not based on prices going higher. This is real adjusted. So you stripped out the inflationary increase. And this is how we looked at this sort of data. The next question we get is, this is all based on credit card spend. So yes, it has increased since those lows of 2022 when we had all those stimulus checks going out, but it's nowhere near the levels we think about where we were previous cycles. So it's not all being spent on debt. We also look at the health of the consumer. The purple line at the top is showing overall household debt payments. And at the bottom, we got the orange line is showing specifically mortgage, and blue is looking at other factors like auto loans, think credit cards, student loans, and the like, which are non-mortgage related. So same thesis there, where we are getting a slight increase in overall debt as a service ratio, but it's nowhere near those high levels, say of 2006, 2007, or even the higher levels that we had in the mid 80s. This is certainly stabilizing. So what are people spending money on? This came out in December. This was a snapshot for 2024, but the BLS, basically capturing what the average person will spend money on in terms of the actual basket of expenditure. So, pretty broad-based in terms of that expenditure. But let's spend time on inflation, because I know this is a big focus of topics. So the blue line is showing the CPI, so what we pay as individuals. So that 2.7% number now went lower to 2.4%. So very pleasing progress, that continued lowering of inflation overall. The orange and green are showing just the price of gas, and then rent costs, which clearly rent is about a third of the inflation basket. So a third of what the average person spends is on shelter costs, viewing it through another lens. So the Fed target a number of 2% inflation. I know some individuals want prices to go back to what they were pre-2022. That would be deflation. So we would have negative inflation. The last time America had, a considerable period of deflation was in the Great Depression. That is not what we're trying to target here, which is why the Fed are targeting 2%. I know some people want zero inflation. That's also not what the Fed are trying to target. So, that's why 2% is the long-term magic number. Very small amounts of inflation is the desired impact. Clearly not what we had in 2022. when which basically led to the Fed increasing interest rates as much as what they did, at this time frame here. So they're trying to control inflation when it got as high as what it did at that environment overall. Another reason why we don't see a major issue with inflation, uh, this is M2 or money supply. This is another way of focusing on inflation. But even if you were just a historian and not even finance, you'd want to know, what happened in society in this time frame here since the early 50s. This was a huge injection. Was the Fed lowering interest rates? It was stimulus checks going out, but basically the economy was on life support. If you look at the blue line at the bottom here, it was the biggest fall in economic growth, since the 50s, which is why there was such response from both the Federal Reserve and the federal government to try get the economy off life support, which unfortunately did lead to inflation when you had so much money injected into the system. Where are we today? We've actually had coming out of negative money supply. You can see how that brown line went to negative. It's more stabilized, which is why it's more healthy. So we're not seeing much inflationary issues coming out of money supply, which is why we're not seeing much scares even coming out of tariffs, not impacting inflation at this point either. So I do want to allow the opportunity for questions, but before that, certainly want to delve into midterms. This is going to be a big topic for 2026. A good way of framing this is we looked at the Dow Jones. So we're certainly not a fan of the Dow because there's only 30 stocks, but what it does have is a rich history. So this is data since 1900, and it divides each year into the presidential cycles. And what you'll notice of the midterms, it is normally the weakest of the 4-year cycle. And in Q2 and Q3, we normally get that period of turbulence. But as soon as we get certainty, coming out of midterms, you see this sort of relief rally coming through. So we normally finish the year pretty strong overall. So that's a typical sort of cycle. We should expect that volatility, let's call it in the middle of the year. Looking into a lot of detail, this is a very busy slide, but if we exclude the red lines, which are recession years, you can see, generally how favorable the stock market can be. Now, we do not expect a recession. We actually expect about 2 to 3% GDP growth. The economy is in a good position. I showed our corporate profits are in a good place overall. But even if we include those recessionary years, you can still see, it's still a good environment overall for the S&P. But we do have these average, price drops of about 20%. So that's that volatility that I mentioned, which is typical for the S&P 500. It is more muted if we don't have recessions, if we exclude those periods there. But look at the recovery. That's what I mentioned towards the end of the year, off those lows that we do have. So it is something to think about in a year of midterms, even though it can be a positive year, particularly more positive if we avoid recession. It is a year we should expect turbulence. I know we've shrugged off a lot of that turbulence. I mentioned Venezuela. Iran hasn't even added much turbulence yet, or even Greenland. But at some point, we should think about that. So this is a question certainly that Mike and Melissa get extensively. Is now a good time to invest? I get this a lot. Particularly in recent years, we've had 3 really strong years in a row for the S&P 500. 23 and 24. We had 24% and 23% for those years. So then to have a 16% return is really impressive years overall. But you have to stay invested. As these age-old, quotes you'll hear about, it's time in the market. But what we notice when we look at surveys, this is coming out of the American Association of Individual Investors. Now, generally, these are non-sophisticated investors, not to say, these are retailers, not to say they're not sophisticated, it's just show that they don't have institutional resource, like Mike, Melissa, and the team. But these individuals generally were bearish or pessimistic throughout 2025. There were only 12 weeks where they were actually optimistic, even though it was a positive year. So it's understandable, particularly with Liberation Day, where they were pessimistic at that time frame. But to have remained pessimistic throughout the year, just shows us that insight into some investors missing out and remaining invested during those times. So this, when it comes down to goals and objectives, I mentioned the expertise of Mike and Melissa, but a great question is when does one ever feel good about investing? And that's why we say be honest. And are these truly long-term assets? And if that can be determined, it really alleviates a lot of anxiety. What we've certainly established that high quality assets, well-diversified portfolios certainly help to grow principal over time. I mentioned how those earnings in those high quality stocks can help increase that over time, and as well as bonds. A lot of our investors have seen the stability of that cash flow profile. Mike Begley, right at the beginning, mentioned we haven't seen some of these yields in over a decade within bonds. So at least that's the pleasing side of the Fed increasing rates in 2022. We are seeing that. And then this is more of a public service announcement about turning it off. We know how challenging it is with the media, the so-called breaking news. We've actually used ChatGPT to create this creative image. And up next, I'll go a step further. Social media. We invest in some of these stocks. We know how powerful AI and the algorithms are. The more you engage in that content, I like to refer to it as clickbait, the more it's going to share that type of content to you. They're trying to sell advertising, whether traditional media or social media. So before one makes a knee-jerk reaction on their portfolio, certainly do consult Mike, Melissa on that. But that's why we do value these webinars, particularly in a year like 2026, when we do have midterms. We know how challenging that can be. So if you do watch the news, do pose yourself the question if you we know how challenging it can be and how emotional it can be during those frames. Your high quality stocks, if you look at your statement, think about those, your classic names, your Johnson& Johnson's, your JP Morgan, these, classic businesses, the one that owns in your portfolio. How much will that news item affect the earnings or business profile of that individual stock? And the general answer is most of the so-called breaking news will not really impact. And that's why I also showed the earnings and the spending of Americans, where 70% of the economy is based on spending. So regardless of politics, we're still going to live our lives economically, which is why we see that resilience of spending continue through that time frame, and hence the economic resilience that we go through during these time frames. I want to thank everyone for attending. Mentioned we remain committed to communicate our latest investment strategy and our thinking. We want our investors to stay on track to achieve their long-term investment goals and objectives.